Hello, welcome to this conversation about remuneration between me, John Butters, and Dr. Carl Sjöström. I'm the chairman of the Holborn Group, Holborn Holiday Parks and Holborn Developments. And what led me to do this has been participating in the Family Business UK network, having dinners and meetings with other chairs of other businesses. And the question of remuneration, and particularly long-term incentive plans, comes up over and over again. But often one has a little chat, and it's not that useful because people tend to compare the features of their own particular schemes that they've built for their own particular businesses. And I think what is really needed is a common ground of understanding of the principles of remuneration, on which I'm certainly not an expert. So I've asked an expert that we've been working with to come and join me for a conversation. It took me a while to find him. I eventually found him through an organisation called Isfahani Advisory. His name, as I said, is Dr. Carl Sjöström. I've got a few little bits about him to introduce him. He's the founder of Viti Solutions, which is his own business, as well as working with Isfahani. And he advises companies, boards and business owners. He's based between London and Stockholm, but he will work anywhere in the world. He's previously been Managing Director of European Reward Consulting at the Hay Group. He's been a partner in remuneration at Deloitte and KPMG. And he's also been Vice President of Compensation and Benefits at Ericsson in Stockholm. He's had 25 years of advising on executive reward in North America, Europe, Africa and Asia, and has lived all over the world in that connection. He also has a master's and a doctorate in business from Oxford University, and I've particularly enjoyed the ability to have an intellectual conversation with him about this area, which is so complicated and so multifaceted. So I'm looking forward to the conversation. We're going to start by talking about base salary and some principles around that as a way into the topic of remuneration. We're going to talk about bonuses, not in enormous detail, but we're going to go into the principles of setting annual bonus schemes. And some of that will then carry through to the bulk of the discussion, which is around setting long-term incentives. So, Carl, a very warm welcome, and thank you very much for coming all this way and joining me for a conversation.
Thank you for inviting me.
I thought as a way into this, we would start with base compensation. So, because there's a few principles that apply to the creation of long-term incentive plans that are general to the field of remuneration. So I thought we would start with base compensation, then bonus schemes, or short-term incentive plans as people call them, the annual bonus, and there's some principles that we can draw out around there. And then the main meat of the discussion will be long-term incentive plans, both the philosophy of them, and then after we've done the philosophy, we'll get right into the nitty-gritty later on. So first, base salary. And the question that comes up over and over is basically where to position salary versus the market, that people understand the mechanics of paying a salary. But how much you pay versus what market you benchmark yourself against is quite a complicated question. So the first question I've got for you is, as a family business, how do we benchmark salaries?
Yes. So benchmarking is a very healthy thing to do. You make sure that the way you pay is not completely out of line with the rest of the market. But it is just a data point. And that's really important to remember. There are way too many companies that see benchmarking studies as price lists, and they're not. I mean, the way we position salaries needs to be based on how we pay in total. That's very important, so that we don't add the annual bonus and the long-term incentive to a market level, but rather we look at it in totality. That is really important, in particular if we're going to have significant variable compensation in the mix. So the positioning of the total and the base salaries will depend on then how we pay and also where we want to be in the market and how we differentiate within the company. So I'll probably come back several times to examples of three, because advisors like to say talk about things in three. But when we look at what drives the levels of pay, market is one aspect of that. So we need to go out into the market, we need to find talent, and we need to attract them into our company, and then make sure that they stay with the company, and therefore we can't underpay them, but we need to pay an appropriate wage. But there are also internal relativities we need to be very careful with. One is the affordability. If we say, well, we just want to have the best work at this company, lots of people will say, I have a fantastic company we built up, and I only want the best to work here. The best are very expensive. And do we really need the best everywhere? And what kind of individual is brought into the company if we're looking for the best? To have an ensemble for your opera that only consists of prima donnas, that's a difficult task to manage, and you don't necessarily get a better performance. So it needs to be part of a holistic view where we look at, okay, so how much can we afford? How do we pay other people within the organization? If we have differentiation, that differentiation internally needs to have a logic to it as well. People always find out what other people are paid, and they need to be comfortable that they're being treated in a fair way. Fair is very difficult because fair is in the eye of the beholder, but the main thing is that the company has a clear view and a clear approach to how you pay. So that's the internal thing. And the third important aspect of how we set levels of pay, what drives levels of pay, is to consider what I call the franchise. So to what extent does the individual we're recruiting in have the upper hand in the power relationship between him or her and the company, or vice versa? So does your brand, if you like, as an employer, allow you to pay less? So, famously, Google used to be the number one favorite employer in a number of countries where they didn't even have employees. They just had such an amazing brand name, and people would work there for more or less free if they could. Now, if you can get people to work for very little, and it's reasonable for them to do so, why would you pay more? So your positioning against the market is important. You understand what the market pays, but it's also important to understand how you are positioned in that market. If you're a very strong employer, that you may not need to pay so much. If you're a weak employer, you may need to pay a lot more. So if you're hiring, say, a software engineer, and you have a strong reputation in your local market, people know you in the town because your business has been there for a long time, so on.
I'm going to try and move us on from base salary to get a little bit more into bonuses. But I would just like to finish off on benchmarking.
Yeah.
Can you tell me about what's good benchmarking? It's very hard to benchmark as a family business because you're comparing yourself to the listed sector, or maybe if you can get private company data, it's private equity. So how do we go about even starting getting sensible benchmarking?
So this could be a long answer. No, but benchmarking is important, and you need to be careful with your sources. So where do you get the data from, and who are you comparing to?
Yeah, but that's what I'd like you to tell me.
So so you can have the data. First of all, you have different versions of data. People will try to sell or give you data in different ways, and it'll be some of it will be very expensive, some may be free. So if you're looking at the listed sector, you can get free information from the published annual reports and accounts of the members of the board, and that'll tell you how much CEO and some of the CEO's direct reports are paid. That data is essentially secondary data. It's old data, but it's free and available. Now, it's put together for accounting purposes and for disclosure purposes. It's not put together to compare companies' levels of compensation. So there are a number of issues with how you analyze, and we can come in onto those details later. But so you just need to understand first and foremost, where is that data come from? If it is surveyed data, it's primary. So it's someone has actually asked the company, how much do you pay someone who does exactly this? Which means that we can compare first, what is the role? And second, we can also add, and through some of the survey providers, what was the complexity and size of that role. So if you're a CEO of a company that has a turnover of 10 million, that's quite a different job to someone who has a CEO of a company that has a turnover of 1 billion. You wouldn't necessarily pay them the same. So, and just those relativities can be looked at through a selection process. So that selection process can involve us either cutting our data by the size and complexity, or by the companies that we know we compete with for talent. So the first one you tend to look at is geography. Most people are paid according to geography. Even if you're in a really international business and you fly around the world and you could get hired into this or that company in the United States or in China or in Australia, you tend to be paid according to local market conditions. And there's several reasons for that. There are some global aspect sectors, but really local market tends to be the dominating factor. Second is your sector. So if sector expertise is there, and also the level of jobs where, so is it a comparable position? Is it a comparable size of job that you're looking at? And for family business, that becomes harder because you have all sorts of aspects that a listed company wouldn't have. First of all, on a discount kind of basis, is that you because you're not listed, executives do not have responsibilities that involve keeping the market happy. That tends to carry a premium to have that listed role. On the other hand, you have the complexities around family members. You have, in a family business, you may not have the career path open to everybody in the same way. So you may need for certain roles to pay a bit more, for other roles to pay a bit less. And in particular, when we're looking at family members, this is quite complicated. Family members often get, you'll often hear the board say, well, the family member makes a lot of money from their equity position. But you need to separate equity earnings and income from employment. If that family member was to go somewhere else, the family would lose that resource. So you need to have quite a grown-up conversation around, one, how much the individual should earn and what is fair in that role, as opposed to money they make from being a shareholder. And secondly, that individual would be giving up career. There'd be a lot more risk that if you had the wrong conversation around the Christmas lunch table, actually your career could be at jeopardy.
Well, so let's go on to bonus schemes, or I've put short-term incentive plans, which is a bit of jargon I've picked up while I've been working on this, but bonus schemes. This is another way into the wider philosophy of reward, so I'm not going to do it to death. But the first question I've got is it necessary to pay a bonus?
So why do we have incentives? And you'll find lots of studies that show that incentives don't work, and you'll find lots of academic studies that show that incentives do work. Unfortunately, a lot of both categories studies are generally tend to be flawed, because in incentives, first of all, incentives always work because the way you structure an incentive is you do X, you get Y. So if someone's done X, they get Y, the incentive has worked. But if you get X and Y wrong, that's not that incentives don't work, it's how you implement.
Yeah, so you said do X and really you wanted Z.
Exactly.
And you said you get Y and then you think actually Y was rather big.
Yes.
You know, you've got it all wrong.
You got it all wrong. And so we need to be very careful with how we use it and why we use it. If we then look back at the salary example, why would it be better to pay an incentive? Well, one, we pay just once for good performance or for whatever reason we wanted to pay the bonus. Secondly, in having incentives, we shift risk. We shift risk away from the company onto the individual. To do that, we tend to have to pay a premium. So the earnings opportunity becomes higher because you accept the incentive. So if you want to pay me a salary of 100 and no bonus, I might also be happy to take a salary of 75 with a 25 bonus for meeting my target. That could be a 50 bonus for doing an exceptional job, but a 0 bonus if things don't go well for the company. That means that in bad times, the company only needs to pay 75. In good times when we can afford it, we can pay more. So that risk has shifted away from the company and the owners onto the individual, and it's in the individual's interest because if things go well, they can do better and they'll take that arrangement if they have faith in themselves and faith in their ability to deliver, which again is a strong thing. But the other thing, the most fundamental one, is that incentives, I'll put it like this, everybody's motivated by money. Problem is we don't know how. So if we can find individuals who are willing to kill their grandmother for $10, and we can find other people who will not sign a piece of paper for $1 million because they feel it's immoral or whatever. So the motivation part of an incentive tends to be at least unpredictable, if not weak. But what is always very clear is that an incentive signals. So the short-term incentive, if we say you can get 25 for doing this and 50 for doing exceptionally well, there's no way I don't hear that X or whatever it is that we've said I need to do is important. And this is a very important management tool for many companies. You can do it for management and just pay a salary, or you can emphasize what the board, the owners, and senior management believe are the right things to pursue in order for the company to be successful through using incentives that signal that this is what is important. But if we say, go generate profits, and what we really mean is to grow the company, then we might not get the right behavior.
But that's one of the most important things you said to me early on in our conversations. You said it's a communication tool.
Yeah.
Because I was very much, particularly again, talking about LTIPs, I was very much thinking, well, what's in it for us? There seems to be a mechanism other than the opportunity to hire the kind of people who want LTIPs, and then you think, well, is that a good thing or a bad thing? This point of having a very clear communication tool was your central point, and it stuck with me. And as I've gone through the process of particularly the LTIP, I've come to understand how powerful that could potentially be. Perhaps we'll get into that later. So let's get on to long-term incentive plans. We've touched a bit already on my first question, which was, why do it? What we've said is it's a communication tool. So if you've got nothing to say, you might consider whether you should just not do it for a while till you've worked out what you want to say. But could you unpack that a little bit in the context of long-term plans?
I think so to unpack the long-term incentive plan, the reason we have long-term incentive plans, I mean, there are many. As we have mentioned before, it's a signaling tool, and it encourages the participants to take a more long-term view. That's common with most. We then also consider things like retention, so keeping people in the company, and the ability to be on the journey with the owners in the value creation of the company. Those are really important factors, but also factors we need to be careful with and think about to what extent it's right to have them and not to have them. I mean, if you want to give me free money, I will not say no. But it has consequences. It costs the family, in a family business, to part with the results of the long-term incentive, and the way we do it is therefore really, really important. So the retention part, absolutely. If I have money that I need to leave on the table, most people will at least think twice before leaving. But if you're in a sector or someone is of a quality where there are lots of people looking, most companies will somehow overcome what it requires to buy someone out.
Yes, yeah, so if they want to poach your people, they will.
They will. And a lot of family businesses are worried about the competition from private equity. For example, private equity often have deeper pockets, and there's a lot of companies are worried about meeting that level of both compensation, but also then buyouts and so on. And I think one needs to be very careful with that. If you go fighting private equity on their terms, it's quite a tough battle. But family businesses have a lot of aspects to them that private equity find difficult to compete with. So I would more consider how can we do that, and therefore design any long-term incentive that you are going to put in place in such a way that it draws on your advantages rather than just trying to keep up. The other thing for family businesses is there's also a tendency to try to be as close to publicly quoted companies as possible. And long-term incentives for a family business or any privately owned business goes for private equity too. Any part of the long-term incentive that is paid out comes out of the pockets of the family. It's not paid for by the market. Private equity can be, of course, at the end sale, but for families, no. Unless you're going to sell the business. So the first question should always be to a family: are you going to sell the business? Because then you will be looking at this differently. If you're not, if you're looking at having this company in the ownership of the family from generation to generation, you need to be very careful with your equity, and you need to be careful with how you pay out equity-like incentives long-term incentives, because long-term incentives, therefore, the greatest threat to the family business is the formula by which they're designed. The formula is what will drive it. And if you have a formula that tries to just copy, say, the market value, you may have payouts that and I've seen this, payouts that drive the business into sale because the business is not flush with cash, the family hasn't got the cash to pay it out, and you've given a large stake to executives, and the executives are looking for payment because they are on a different time trajectory to the family.
Well, let's go on to the detail of an LTIP. The first big question I've got is what we should be paying out for. So we've already touched on this a little bit with profit, so it takes us there quite nicely.
Yeah.
One thing that you said to me, and this is the thing, above anything else, has driven my construction of our LTIP, is payout when shareholders will be delighted to pay.
Yes.
And that's totally stuck with me. Shareholders pay, so they ought to be delighted to pay. So there's that. But then you get into this question of, well, when would they be delighted to pay for some long-term thing, some kind of long-term value creation? And that's quite hard to measure and understand. So can I leave you with that?
Yes. So one of the classic phantom share plans that you'll find in the market is quite a scary thing, where you say, okay, so how does a share plan work if we're a quote company? Well, we could argue that it's our profits times our PE multiple that equals our share price.
Yes, so this is the ratio of price to earnings on a listed company, for those unfamiliar with the jargon.
Yeah, sorry, exactly. So that leads us to go, okay, so we make profit of 10, and then we go to all our listed competitors and we get what is the average PE number that they have and say that is 10. So therefore, the value of our company is 100.
Yeah, so you make 10 of earnings and your listed competitors are on 10 times price to earnings. So you say, okay, my company is worth £100 million.
Exactly. And it's quite helpful. You'll find a lot of venture capital, private equity valuations will link back to that sort of formula. So it's a fair guess, right? But when we're talking incentives, we're then, if we're going to say you will earn according to the value increase of our share or the value of our company, or we'll link your long-term incentive to the value of our company, then we have a very strange sort of 10 times the multiple of some competitors. I mean, if you're in the wrong industry, say tech business, where the multiple is maybe 20, 30, 40 times, you can be giving away an awful lot of the company on that sort of multiples.
Yes, so
and actually it could be worth improving the multiples of your competitors rather than your profits. Hypothetically.
That's a very good point.
Yes.
But so also, if we've done this maths I talked about earlier, your company's earning 10.
Yeah.
You say the company is worth 10 times what we're earning, so we're worth 100 million.
Yeah.
You have a good year, managers make you 20. So then you say, well, congratulations, for the company's now worth 200 million.
Exactly.
And we'll pay you the share of the extra 100 million of value you've made us.
Yeah.
That's very dangerous very quickly as a business
You've given
owner.
away 5%, you've given options over 5%.
Yes.
Then it's £5 million.
Yes, quite.
That's on a 10 million profit. So you could even be giving away more.
Yeah. So we're talking about value creation.
Yeah.
And the point here is be careful about saying the value that management has created this year is some large multiple of the extra profit they've made this year.
So this is what I mean by be very careful with the formula that your incentive is based on. So if we then take that formula and we think, okay, so what is it that we would be happy to pay for? that sort of challenges this PE multiple shortcut. What is PE multiple? Well, it is the market saying we believe that level of profitability will continue to be delivered or improved upon into the future, so therefore this is how we value the company, this is how much it is worth, hypothetically. We can do the same with the company as shareholders. Now, what do we value in the company? What is it that we as a family appreciate in our company? It may be profits, it may also be how the cash flow works, how predictable the cash flow is. It may be reduction of debt. It may be how we protect certain assets and how we encourage bigger bets on other assets. It may be all these factors depending on what kind of company we are and what it is that our plan for long-term success is. And that's really, I mean, put it very simply, if you want to share the wealth creation with your management, it should be linked to your plan on how to do that.
I think this connects back to an earlier discussion as well, that one of the reasons that I'm not entirely sorry we've opened the LTIP Pandora's box is that it does make you think. And you have to be able to sit down, not with management, who, in a family business, you might well, if you're relying on professional managers as we are, it's their intelligence and their market knowledge and everything else that will drive the strategy. But you need to be able to sit down as a board and say, well, what actually exactly do we want? Yeah. And what actually exactly don't we want? And it seems to me you can't do an LTIP properly unless you've done that thinking properly. Yeah. It really forces you to think. Let's go on to the downside protections. So we put in some emergency brakes, and this is something you were very helpful on. So another of the things you said early on was penalise increases in risk factors. And we've given ourselves fairly broad discretion to pull the emergency brake if customer feedback deteriorated a long way, if team feedback deteriorated a long way, if health and safety deteriorated, if capital assets were not maintained, or crucially, if the dividends were not paid, then we don't have to do any of this. One of the opportunities here for me has again been to demonstrate the importance to management of things like employee surveys, because we need to know now whether or not we've continued to be a good employer. And if we don't have the data, then we may well pull the emergency brake. So not only has it been a chance to communicate clearly to management what are the big risk factors for us that we do not want to see go downhill, it's also been an opportunity to signal that we really must have a monitoring framework around this. Otherwise, the LTIP is at risk.
No, I think that is a big advantage for family business to be able to be much more careful around what the risks are. And it's really important that incentives are operated within the risk framework of the organization. I think on the employee engagement, as we've discussed, and I think for our audience it's an important note to have, because employee engagement is very important, but one needs to be very careful with putting it into incentives explicitly, because then it can easily become an incentive to make employees fill in engagement surveys in the wrong way. And it sounds funny, but I have seen that go very wrong, and it's not that can be more destructive than anything if we get managers misinterpreting how this is going to be used. But absolutely, like you have done, to have clear indicators around what is, and in particular, unacceptable outcomes in the pursuit of this strategy.
One thing that you were very clear on in a lot of the fail-safes, and also in some of the complexities that we'll get onto later, what happens if, you've often counselled wide discretion. Because you've said, look, you can't foresee everything, and if you try to foresee everything, you're going to pay a lot of lawyers a lot of money, and you still won't have foreseen everything. So you've counselled quite a lot of discretion, not in the formula. There's a bit of discretion in the formula for unusual events, positive and negative, affecting profits.
Yep.
But a lot of discretion on the emergency brakes. So could you unpack that a little bit?
Well, as I said before, the formula is the greatest threat to the LTIP, and it is important that we protect the family as much as possible, but we also need to make sure that the incentive is something that management can trust. So there's no worry from management's point of view that this will not be delivered if they perform, because then you would have wasted money on an incentive that they didn't value. A little bit like we talked about earlier, you when you had a discretionary bonus plan, you didn't count on the bonus. If you get into the same situation with the LTIP, that's a negative, because management is not appreciating what they're working towards, and you lose lock-in effect, you lose maybe even focus on what the incentives say. So you don't want that. But here, we established that we have a very good relationship between board and management, and we have an open process. You also have a board that is looking at this together. It's more than one person. You have a collective review and evaluation of this. It's not as if it's going to be chairman's whim that casts one way or another. So if one has a good governance structure, a good relationship between management and board, which most family businesses will have, then you should make sure that you protect the plan both ways by having a bit of discretion in there, because it is impossible to do everything on formula. Where you have a listed equity, it is much easier because the market can take into account gazillions of variables. Still get it wrong a lot of the time, but at least you have a market buffer there to help you with that. But in a private situation, you don't. So you should limit the risk. In particular, if you want to have more sizable rewards or opportunities for management, the more important those checks are.
Actually, you raise a good point that we've talked a lot with the assumption that we're talking about medium or large unlisted, as in private businesses. One thing I wanted to pick up on that is another assumption that's kind of run through what we've talked about, which is that we would pay out cash. So the scheme has some formula, it works out how much cash we pay out. Now, in olden times, it would have been possible to have some arrangement with shares and structures and what have you, and you effectively wouldn't pay out cash. You'd somehow make it a capital gain or something. My general impression, having talked to you and our tax advisors and what have you about this, is that if you try and play clever games to alter the tax treatment of these schemes by having fake shares or some sort of options that have a notional value or anything like that, increasingly HMRC will just look through it and say, that's income, and we're taxing it as income. And what the context of this is, of course, trying to get the tax rate of the recipients of these payments as low as possible.
Yeah.
But I think a lot of that ability to play games around that's gone away.
It has, and also, I mean, even if there are tax opportunities to be had, most those that are there are HMRC designed. So, but you should consider first of all, always what the incentive is meant to do, because it's nice if the incentive can deliver a tax break for the recipient, but if that is at the cost of the family's long-term wealth, then it's very doubtful whether you should do it. you should always consider the reputational damage, even of a plan that is entirely blessed by HMRC. Will it be so in a few years' time? In the eyes of the public, and how would the family feel about it being on the front page of the Daily Mail? That test should always be there. And tax planning, it's a separate subject, but it should come after choice of incentive structures. You can alter the incentive structures later on to make them tax efficient if there are such opportunities. But most larger businesses would be extremely cautious. There are opportunities around allowing executives to buy equity and earn equity, and then if that equity grows in value, but it comes back to what we talked about before. If it's equity, it'll need to be sold at some point. Who's buying it? Is the family going to be able to buy back the equity? Or will you have to sell businesses or something in order to do that? Because the executive, even if the executive's been with you for 20 years, come retirement, it's their money, their investment. Why would they be happy to just follow what you and your cousins want to do? There will be a conflict of interest that at least should be planned for.
Yes.
And they will want to get the money out for their family.
We've done a lot of theoretical stuff about LTIPs now, and I'd like to get down a little bit more to the features of the construction of them. So I've got two groups here, structural questions and complexities. So if I start with the basic structural questions. The first one is, who should participate?
Right. So for a long-term incentive, we can achieve, as we discussed before, different purposes. And you can use it in different ways depending on, again, type of organization and so on that you are. So you may want to have an incentive where everybody participates. You talked about the profit share before. The save as you earn plans and so on, where you invite everybody in the company to share in the long-term success of the business. Then you can use a long-term incentive and some short-term incentives as being a member of the club. There's a lot of value in that. If you look at like Maslow hierarchy of needs, kind of satisfaction that at some point we need to clothe and feed ourselves and our family, and so we need to provide for that. But then we go into self-esteem, self-actualization. How can we as an organization touch on some of those factors to get value out of our employees? Now, being a member of the club, getting recognition for that you are one of the senior team, but the broader population can be very effective. Can be a very strong way of maybe not paying so much to the individual, but giving them recognition for that. You are a key contributor. You are someone who we value in this organization. We see that you have a great future here. That signal can come through an incentive. Many organizations use that.
That strikes me as a good club to be able to offer, rather than a board seat. I think
it can be.
You can end up offering a board seat as that kind of welcome, you're in the club now.
Yes.
But then that doesn't necessarily think about board dynamics and who contributes as a director separately from contributing as an executive or expert.
Yeah.
So I like the idea of having another club into which people can be inducted.
And then you have those that you want to or need to and you have to be careful. So, to what extent do you have to what extent do you want to have people in the group that share in the wealth creation of the business? So, where there's more serious money in the long-term incentive, where people they have preferably a strong line of sight to delivering results for the company, to being able to impact the strategic direction of the company. People who you do not want to lose interest in where you are going as an organization. That's the final tier, if you like, of incentives. You can use incentives for other purposes as well, but I'd say those are the common key usages of a long-term incentive.
What about the scheme length? So we looked at the scheme length and we were inclined to go longer, but actually discussions with you were quite useful. That your view has been, well, managers don't believe anything that happens beyond 3 years. I'm paraphrasing in my own way, but the market standard in listed companies is 3 years, and there's a reason for that, because longer than that is getting a bit long.
It is. There's no science to it, but we want a period that is longer than the year. And we tend to define short-term incentive, 12 months and less. Some have quarterly, biannual, but most have annual incentives. And then long-term incentive is anything longer. Depending on who you are, what business you are, and so on, you will have different length perspectives on time. But you also need to take into consideration the individual's perspective on time. So how long do they plan to be in the job? How long is a reasonable expectation to be with a company in different roles? And are there cycles to be met? And if you take a 3-year cycle, 3 year is a time period for most individuals that is yes, you can look at and you can see yourself being there. Having 5-year plan makes that tougher for the individual.
Yes.
There's a long way.
You've got to do your full 5 years before anything happens.
Exactly. So to get people engaged, not having to pay gap payments to keep people locked in. 3 years have just worked out for most as a reasonable time period, but it's not universal. Different companies struggle with different things. So many tech companies, for example, they have vesting that is annual. So maybe in a third. Some even have monthly. And back in Silicon Valley, you'll find very intense plans that work over long. And it all depends on how you are as a business, what the retention needs, what kind of patterns people are likely to be following. But 3 years, as a general rule, has evolved as the standard timing in Europe.
I was also very concerned about having a 3-year or a 5-year one-off scheme. Partly because, going back to the point about it's the family saying this is what we want, we're not clear over what we want over 3 years. We have a much longer time horizon than that. Also, I'm very wary in our business of having these cliff edges, because it is a decision point. You have a good 3 years and you say to management, right, here's a bunch of money, and it's tantamount to saying, do you want to stay or do you want to go? And saying that to our whole team at once in our business, where we would struggle to re-recruit everybody all at once, I don't think we've got the capacity to do that, just seemed very frightening to me. So we have gone for these overlapping schemes where each year we launch a new 3-year scheme. This is in the yield business. And I think that's very common, and it's what public companies are tending to do as well. Now, I think I've probably said enough that people get the idea. The problem with it is this immediately starts to bend people's minds. And after swimming in it for a while, what I'm seeing is the point is it's a lock-in mechanism, and it can also be a good lever mechanism that you say, well, if you're a good lever or a graceful lever, we'll let you keep some of these things whenever you resign, you're always going to have 2 live plans running that you're going to lose if you leave. So it's a graceful leaver mechanism, and it's a lock-in mechanism. But this is quite mind-bending for people. So how have you found boards react to this structure?
Yeah, no, it is, in particular, as you say, it's common practice in publicly quoted companies, so that you get less reaction there, less so in privately held companies. In the private equity sector, as you've described, you want to have the payout at the exit. That's how the whole business case works, and the incentives have to follow that. But I don't think I've come across a one-off plan where there hasn't been an exodus of some sort after, if it has been successful.
Yeah, okay, so if there's a one-off plan and a cliff edge,
Yes.
there's almost always an exodus of managers at that point.
It's very, very common, because you are, by design, creating a point of reflection for, do I want to stay for another 3 years? If you have ongoing plans, it is just part of your reward that is being delayed. If it is one-off, then you create a point of reflection where each executive has to think about, am I in or am I not? And it may be that they're in, but they can only see another two years forward for themselves. And if you'd had ongoing every year plans, that wouldn't have been an issue. But now it becomes an issue. So they jump, and or they go and get that new role.
You mentioned earlier the importance of having a cap, and this was around the formula risk you were talking about. It's another of the things, the kind of key pillars that I've taken from you. You were very strong on always have a cap. Yes. And it's quite intuitively appealing to say, well, there's no cap, guys. You make our business a wild success, and you get a wild payout. Yes. But you didn't advise that at all, and that was interesting.
No, I think it's important to consider the risks of the plan. And uncapped plans, as I said before, the threat to the company from a long-term incentive in particular is the formula. And I have not designed, but I've seen plans that have gone seriously wrong on the formula and look to pay out way beyond what was reasonable or and should have been paid, leading to court cases and so on. The cap can be high. There's nothing stopping you from that, but the board should consider at which point it's not reasonable for the family to be paying whatever amount it is. And yes, there are risks of sandbagging and manipulation of results and so on, but the risks of an uncapped payout for beyond what the board can envisage today, that if you're not quoted in your family business, you can still pay more. That is open to you.
It's a good point. You can always pay more.
You can, if you see after 2 years that there's a massive opportunity, and if management takes it and they double the value of the business, you can put in another incentive. But to backtrack on a promise and capping an incentive just before vesting, that will not lead to a harmonious relationship between management and the board.
Well, let's go on to complexities then.
Yeah.
Complexities, where I hope we don't get too lost. The first one we've touched on, I've written EBIT, EBITDA, net profit, comprehensive income, cash flow, operating profit, ... You do need a core metric. And again, another thing that you advised us was keep it relatively simple. You've got to have, even a simple plan is going to be full of complexities.
Yes.
Just because of that thing we talked about earlier, or I talked about earlier, of taking a simple idea and rendering it into maths.
Yep.
If you're then doing that with a profit concept, or a return on capital concept that people don't really understand, you're just creating a whole world of further confusion and mistrust potentially.
Yeah.
So one almost has to pick one of these common measures of company performance. But which one? And I've really struggled, particularly with net profit versus EBITDA. To some extent, we're a yield business. And so the more EBITDA you can take out, the better. And then it becomes the board's responsibility to make sure enough investment is going back in. If you're using net profit, you are paying out of, you're more reliably paying out of cash you're likely to have because you've got that depreciation charge in there, which on our business is a pretty significant thing. But to some extent, you're disincentivizing capital investment because the more capital investment you make, the bigger the depreciation charge. And anyway, so this is just my little problem, but there's a gazillion problems with choosing the metric.
Yeah, and in one's quest to make things less complex, you have to make a call. And the board will often have very different views because of people come from different angles and different experience and different background companies on which metrics are the more important, and it's quite healthy that at board level because you'll have a debate around it, and just what you illustrated, these are things to consider when you're evaluating the strategy and the performance and what to do next. When it comes to the incentives, though, you got to come back to your signaling. So what is it you want to signal? And if you need to signal on those finer points, maybe just general profitability isn't where you should be going. So I would probably look first at what is the most common thing you talk about within the company. So if everybody in the company is talking about EBITDA, and that is the mantra from the CFO down throughout the organization on a daily basis, if someone else suddenly starts to talk about EBIT or about net profit or about economic profit, which is, many people think it's very where you take a capital charge into account, it gets confusing and mixed messages, and people start to switch off, or they'll most likely start to use the interpretation they prefer, which might go in completely different direction to what you want to do, and then people will be disappointed because their EBITDA is up, but the net profits were down, and we were measuring on net profits, and so everybody thought it went really well, but we're paying nothing for it. So you just need to be consistent. You need to consider what's the message and how do we use this signaling most of all, and then pay accordingly. And if you need other buttons pressed, well, maybe we need to introduce a secondary measure like investments. Making sure that there's sufficient investment decisions made and incentivize that, or whatever it may be that we're concerned about.
Let's go on to some other complexities. Should it be contractual? And you've said no. Again, we've made it very discretionary. But are there arguments on both sides, and also what legal risks arise, even if you write everywhere you possibly can that it's not a contractual entitlement?
Now, for some organisations in some countries, you can't remove that, and you have to make it contractual. Some companies feel much more comfortable with it being contractual, but then you need to be very, very careful with how you set levels of opportunity, so how much you can earn, and also how easy or difficult it is to earn those levels of pay. Because if it's a contractual right, people could challenge you in that if you made it much harder to earn it, have you broken the contract?
Yes.
Yeah.
So you can have challenges all over the place.
Yeah, challenges all over the
Good
place.
point.
So it tends to be easier for the board to operate a discretionary plan.
A point that you made about discretion in our conversations when we were talking about, well, should we have this or that provision for good leavers? A good leaver looks like this, and if you're a good leaver, you get to keep that. This was another area where you said have discretion, and you made the very good point that what's a good leaver is very situational. That it might be that you want to say, well, how very kind of you for letting me know you want to go, and it would be great if you could go tomorrow.
Yes.
And in other cases, you might want to say, well, it would be extremely great if you could go in a year's time. And it's a good idea for the board to have discretion to say what is a good leaver in different situations.
You do have to be careful with setting precedents and so on. But family business, again, as you say, there are so many circumstances, and as long as you maintain trust between the board and management, and as you say, bear this in mind that yes, if you're sitting in a room by yourself with just the board meeting and you're discussing what is good and what is a bad lever, you may look at it very abstract, but just reflect back on this is how we will be treated. People will see us treating people like this. This impacts us as a business, as a family, and our reputation with our management, who we rely on to deliver value for us. It's easy to talk about it hypothetically, but it's hard when you put it into reality, and therefore to be able to have the discretion to call it according to the situation. I think if you can, that's valuable.
I'd just like to finish off with one last question. You are a consultant, of course, and you help people sculpt these things for a living. We haven't done an example really today of how you sculpt one. So, I hope it hasn't been too philosophical and general for people, because I always love to hear the war stories about, well, this was the problem, so we did that. Yeah. What I'm interested in is how to manage the consultants that you take on to help you with this.
It is a very specialized subject, although we all think we're specialists on this because we get paid, but it is also, there's a lot of complexity. People are very worried about the complexity. Use the consultant to get through some of that complexity, to arrive at a common understanding, and maybe take it a step further to start looking at your reward philosophy. We've touched on reward philosophy a few times, but it is very helpful if we can get, as an organization, a view on what we like and don't like when it comes to paying people for their work, and when it comes to allowing executives to share in the value creation. That's all we try to get at. And if we can get a view on things like, do we like incentives? You asked before, can I just have salary? Well, you can just have salary. It works. There are consequences of just having salary that you need to deal with if you're going to do that. Can I just have bonus and have people work on commissions? You can, but there are consequences to that. People can't rely on their compensation to have a house and food on the table and so on. Then they will act in different ways. You get behaviors and you get actions from the way you structure pay. Should we be a paternalistic organization? Many family businesses want to take care of their employees. Should we therefore have defined benefit pension plans? You can have that, but it's a massive risk to the family in making such promises, as many families have found out. So all those things, the fundamentals, if one can agree on that as a board and as a family, that's extremely helpful. And you can have your advisors help with that, and from that you can create policies. And it sounds very bureaucratic, but what a remuneration policy needs to be, and all it needs to be, is a framework within which your managers can take decisions.
You said consultants should advise and the board needs to decide.
Yeah.
And I think that's one of the connecting threads of this whole discussion. That there's the basic point we talked about at the beginning. Your salaries for turning up and not doing a terrible job, your bonuses for hitting this year's targets, whatever they may be, and your long-term incentive is for doing what the owners or the board have communicated to you is their long-term objective.
Yep.
So they have to know, they have to have something to say to you as an executive, otherwise there's no point in doing an LTIP. And they need to I suppose, step up to the plate and grasp what they're asking for, because otherwise the whole thing just doesn't work. This whole thing is a kind of I don't know what the right analogy is, a dangerous radioactive substance that you can also use to your benefit.
Yeah.
It strips away the I don't know and the we're not sure and we don't manage that very well and there's this unspoken thing here and we don't really trust so-and-so and we're not sure what return on capital we want and so on and so on. It strips all of that away as you try and do, particularly an LTIP. You've got to get clear, and that is a great advantage, and it's also the great challenge of putting it in. That's what I found. Well, Carl, thank you very, very much.
My pleasure.
Very, very much. It's been a very interesting conversation. I've learned something. I've learned a lot, as I do every time we have a good conversation. So thank you very much, and I'm looking forward enormously to sharing this with Family Business UK members and whoever else we share it with in due course.
Great.
Thank you.
Excellent. Thank you.